So Robert, let's start with retail sales. For autos in particular, you said in your report that people replaced their ruined cars and drove off with expensive gas. So what was the spike in retail sales?
Yeah, we did see a pretty hefty increase in sales in September. And that was, of course, that was all hurricane related. Because these are nominal sales numbers, we knew that unit auto sales were up for the month, 18.6 million unit rate. So the dollar value of retail sales for autos also up. And then, of course, gasoline stations, a big component of retail sales, just follows the price of gas, doesn't reflect demand usually. And so we had a lot of refinery shutdowns. We all saw higher gasoline prices. In fact, still a little bit higher across the country than before Hurricane Harvey hit South Texas.
So in August, we had gasoline prices at $2.36 a gallon, and then September $2.66, and now it looks like they've settled around $2.51. Where do you think we go from here for gas prices?
I think we could lose another dime over the next week or two, and maybe another dime after that. The key driver, of course, is oil prices, and oil has come up a little bit from, say, around $45 a few weeks ago, closer to the $50 mark. I don't expect oil to go much higher in this environment. There's still a lot of oil out there, a huge amount of inventory, and that's got to get sopped up before the oil market fundamentally tightens. So really the idea is lower for longer continues, and that should keep gasoline prices in check for, say, the next 6 months to even a year.
Okay. So also out this week was the Consumer Price Index for September, and you say that some components of the CPI were mixed. Are we seeing hurricane effects on those numbers as well?
Well, certainly. We've already talked about gasoline prices, and that's an important component of the CPI. It's also a component of the Producer Price Index. So the energy sub-indexes of both those series were fairly hot in September, and we'll see them come down. We'll see the mirror image of that in October into November as gasoline prices and other diesel fuel and jet fuel and all those other things start to settle down. This is important, though, because it informs the debate that the Federal Reserve is having over inflation right now, and weaker than expected inflation. And they're going to have to put on their glasses and look through the energy data and look into the core components, non-energy components, where we're still seeing, fairly modest inflation amongst a lot of core components.
Okay, let's talk about what's coming up this week. We have information, housing data. What do you expect there?
That's another case where we're going to see some hurricane effects, probably keeping housing starts and permits, in the range of 1.1 to 1.2 million. The big story there is there's no momentum in housing right now. We're not seeing any momentum, any clear direction in the construction data. We're not seeing any momentum in the home sales, both new and existing home sales data. So this is a very different economy. We're used to thinking about housing leading the economy forward and let it off the cliff in 2006, 2007. But this is definitely an economy where housing is trailing the economy. And certainly these hurricane effects will keep it back on its heels for a little bit.
Okay. Also, what kind of data on leading indicators do you think we'll see next week?
Yeah, leading indicators I think will be positive but small. We've got a lot of 10 major components going to the leading index, mostly positive, but the housing component that we just talked about will be negative. A key positive is going to be stock market, which has been doing relatively well despite the hurricanes. So leading indicators is designed to look about 3 to 6 months out. I think staying positive and consistent with finishing this year with moderate GDP growth.
All right. Thank you, Robert. If you would like to read Robert's reports or subscribe, go to Comerica.com/economics.